Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer, the information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.
Welcome to another week of the Brokers Lounge. This time I'm joined by Richard. Richard is the head accountant at Inkwell Group. He's CPA accredited with over 30 years of experience. Richard will be replacing my favourite co-host, Carlo, but I'm pretty sure we'll get a lot of information, valuable information out of this podcast and ask all accounting and property-related questions. Richard, welcome to the Brokers Lounge. How you doing?
Thank you very much. Yeah, glad to be here.
Looking forward to it. Same. How you been? All right? Things been good?
Yeah, very busy.
Very busy, yeah. You joined the group not long ago, but there's a lot of work to be done, and we're already benefiting from your valuable experience. So thank you.
My pleasure. No, it's great to be here and looking to assist the group move forward.
That's it. I think what we'll be touching on today is tax structures for property investment. We'll touch on negative gearing and the tax benefits, and we'll try and touch on self-managed super funds. So let's take it away. So tax structures for property investments, there's always that question. Should I buy in my personal name? Should I buy in a company? Should I buy in a trust? So do you want to give us like an overview of common tax structures and the pros and cons of each?
Yeah, certainly. So that's a common question with clients is, and it's probably the most important question is, how do I go about structuring this to give me the best results? And, first of all, do you buy the property in your personal name? Do you buy it in a self-managed super fund? Do you buy it in a trust? Should it be a unit trust? Should it be a discretionary trust?
Yes.
Now, these are all the sorts of questions that are asked, and the right answer comes about by your personal circumstances. So essentially, they all have different advantages and disadvantages because of the way the tax is structured. And essentially that's the first cornerstone in terms of working out which is the best way to go.
Absolutely.
Yeah.
From what we see, I guess the most common structure is personal versus trust. Mm-hmm. And before we jumped on this, I was asking you about a case we've got where this client has got multiple investment properties in a trust, and obviously he can't benefit from any negative gearing. That's right. And that has an impact on his current tax situation. Mm-hmm. But then move forward 5-10 years where the properties are positively geared or paid off, then that can benefit him in a different way. So let's talk about this example and what would the difference be if he had purchased those properties in his personal name compared to in a trust.
That's right. So in that particular circumstance, the property is negatively geared. So that's one of the disadvantages of buying in a trust is that when a trust makes a loss, that loss can't be distributed out to the beneficiaries.
Yes.
Whereas if it was held in your individual name, those losses can be used to reduce your taxable income, and which results in significant tax refunds.
Saves, yeah.
Which obviously improves your cash flow position because you're getting that money back from the tax office.
Absolutely.
The other side of it too, I suppose, is that if it was purchased in a company pays tax at 25 or 30%. But in a company structure, if you have a property that is sold at some point in time, that property isn't entitled to the 50% capital gains tax exemption.
Okay.
So it's important when, looking at purchasing a property, what is going to happen over that period of time? Is it something that you're going to hold? Is it something that you're going to sell?
Yeah.
and that makes that decision of which structure you're going to go with very important.
Okay, so from an accounting point of view, what is the biggest benefit of buying a property in a trust or a company? Mainly asset protection, I assume?
Yeah, that's right. So it's mainly asset protection. In the company scenario, it's probably a structure I would less recommend to buy a property in because of that capital gains tax exemption not being available. And then also with a trust, the benefits of the trust structure is that when the property is positively geared, you can distribute that passive income to any of the beneficiaries, and that can also include a bucket company as well, where you can be spreading that income over multiple people using the various tax-free thresholds to reduce your tax.
Would you still benefit from the capital gain tax concession in a trust?
Correct, you do. Yeah.
Okay.
So that's something where if you're looking to have asset protection and benefit from the 50% capital gains tax exemption, you would go for a family trust structure.
Okay.
But if it's negatively geared,
then you can't benefit from the tax
throughout the time when it's negatively geared. Okay. That's right.
And I guess that's where working with the team to find the balance between the best borrowing finance solution while benefiting from the right structure. Because from an accounting point of view, it's probably best for asset protection and tax minimization. From a lending point of view, it might be working against that because you can be capped, or like sometimes buying in a trust can allow you to borrow more because you can borrow in different entities at the same time. But then you have to let go of like tax benefits, and
that's why it's probably something where you look at it, first property, it might be in personal name, and then you might move to a super fund, then you might move to a trust, so that you're utilising all of the tax benefits that are available in our tax system through all of the different structures that are available to you.
What are some of the common mistakes like you see with properties? I think I can tell you about one, and probably you can confirm, where someone is starting a business, they start making good money, they're growing, they had their first property, then they buy the second property in the personal name, then the third property in the personal name, and then
they can't borrow anymore.
They can't borrow anymore, and then even if they want to buy in a trust later on, they're capped out because they've got plenty of debt in the personal name. Is that one of the common mistakes you see?
Yeah, I think so, and I think that's where that advice at the start is so important, because getting that structure right from day one, and that's where talking with yourself and other professionals, working together, we get that right for you, because making those right decisions is where you're going to save a lot of money down the track.
Heaps. Because now if they want to move that property to a trust, obviously they have to pay like stamp duties and the transfer costs and all that sort of stuff.
That's right.
And if they sell, also they're going to miss out on keeping that property and benefiting from all the gains they've had. And
potentially, it's CGT there as well.
100%. So. All it took was asking the question to the right people 5 years ago, and setting these structures straight.
So a little bit of money spent at the start,
goes a long way.
Save you a long.
Absolutely. Thank you so far. It's been pretty good. I guess we touched a bit on negative gearing. So this is always an interesting topic. A lot of people ask us about it all the time. So briefly, what's negative gearing and how does it work?
Yeah, so negative gearing is essentially when a property, its expenses exceed the income that you're making from that particular property. So with any property, there are many tax deductions available to you. And, they can range from, the bigger ones are interest on the loan, and then your depreciation, where you can claim the construction costs of the building, and then all the other various bits and pieces like,
maintenance
rates,
costs,
maintenance, land tax, etc. So that's negative gearing, where the expenses exceed the income. Now,
How does it work?
basically, that loss that you make relating to the property, that reduces the taxable income in the entity that it's owned. So if it's in an individual name, your taxable income might start at $200,000, but you've made a $20,000 loss on that property. Your taxable income goes down to $180,000, and because you've essentially reduced your taxable income by that $20,000, your tax bill at the end of the year will be reduced by that $20,000 by your marginal rate. Which,
What's like an estimate?
let's just say it, 47%. So on that $20,000,
it's
it's
like
$10,000.
Yeah.
Roughly.
So technically your loss is $10,000, not $20,000. Yeah, right?
That's right.
Yeah. So that's where people miss the larger picture where, the property is losing $20,000 a year. I can't afford it, or it's a bad investment. But then if you do the numbers, it's only losing $10,000. And the gains or the growth of that property should, exceed the losses down the line. And so that's where people just get stuck in the moment where it's losing. I need to get out. It's not good. And then they miss out on potential.
And that's the whole idea, is that the growth over, the longer term is going to exceed those expenses that you're incurring, over that period of time.
Yes. And what's the risk? Like, at the same time, some people rely on negatively geared properties for the sake of tax benefits or saving some tax. What's the risk of relying on a negatively geared property?
Well, the risks are, all the different, factors that affect property. Are the interest rates going to go up? Are you not going to have a tenant for a period of time? Are you going to lose your job and not be able to cover that shortfall?
Yeah.
So they're all the sorts of things that, you need to think about. But I always say you need to do something other than just working to get, to reach your financial goals.
Absolutely. And property, from your experience, is
it's one of the best ones.
Yeah,
that's right.
Absolutely. If you had to choose between a negatively geared or a positively geared property, what would you choose, and what would you look out for if you're choosing a property in general?
Yeah, look, in general, if it's possible to purchase a property that is positively geared, that would be the best approach, because there's far less risk. And in terms of, looking for a property, it's really about something where you're looking for the area that the property's in. Are you going to get good capital growth over that longer period of time? It's not something that you're looking at for 1 or 2 years. You're looking at that 10 to 20 year mark. So it's a long-term strategy.
Okay. Lastly, on the negative gearing and tax benefit section, so obviously you mentioned the interest expense is the biggest expense, and all the associated costs that comes with running a property or maintaining a property. What is something you recommend for people to do from an accounting point of view that makes that end of year lodging their tax returns easier and they capture everything so they're not missing any of those expenses?
Yeah, look, it's really about being diligent in keeping all of your documentation. In terms of tax returns, it's all about being able to substantiate your claims. So if you keep everything, you're able to claim the maximum possible, and that way, there's more money in your pocket at the end of the day.
Yeah. And how important is it to have a depreciation schedule?
Oh, that's one of the most important things.
Yeah.
So, getting a quantity surveyor report, that's, in terms of, I suppose, the deductions, that's probably, the second biggest one, or could potentially be the biggest, depending on the property. Because that one there, it enables you to not actually pay out those expenses throughout the year. It's not like it's interest or repairs. It's the cost of the building and those assets that are in the property that you're depreciating. So essentially it's a non-cash expense, but you're claiming it as a tax deduction. So
which has
very
a
important.
cash benefit.
That's right. Yeah.
Yeah, absolutely. That's what I always tell my clients. Like getting that report will cost you $1,500 to $2,000, which is tax deductible as well. And then the benefits.
I can find them for like 700,
Yeah.
600. Yeah.
Okay. There you go. And it lasts 40 years, right?
That's right.
So you're claiming all this depreciation on the building and the assets over 40 years, which will save you a lot of dollars.
Look, generally speaking, I always see that it's sort of something in the, at the minimum end, $5,000 extra of tax refund.
Yeah.
By having that report done, and usually it's more like 10,000.
Yeah. Well, usually the 1,500 is like valuation and depreciation scheduled together because you want to also know what the value is at the time, so you can put that down for
understand where you're coming from.
Yeah. All right. Anything you want to add on negative gearing and structures?
No, I think that covers it.
Yeah. All right. Now the this topic has been very popular recently. Every person is just giving advice on it, from real estate agents to buyers agents to plumbers to mortgage brokers to everyone. It's self-managed super funds. All right. They've been very popular lately, and a lot of people are looking into investing in the self-managed super fund. From an accounting point of view, obviously, there's a limited recourse borrowing arrangement that needs to be done in the self-managed super fund to be able to borrow money.
Yes.
So what is a limited recourse borrowing arrangement and why is it important?
Yeah, look, it's basically just the loan that you're taking out in your self-managed super fund so that you can purchase a property. And in that name, it has limited recourse, which means that the bank only has recourse to the assets within your super fund. It doesn't extend any further to personal assets or anything outside of the self-managed super fund. So, in doing that, you have to set up, in addition to the super fund structure, which has a corporate trustee, you have to set up a bare trust with a corporate trustee as well, and that then enables you to borrow to purchase a property.
Can you borrow or purchase property without that limited recourse borrowing?
No, you can't.
Yeah. So it's non-compliant anyway. It's not legal to do it.
That's right. That's the only way you can do it.
And you can only have one asset in each bare trust, right?
Correct.
So every time you buy another asset, you have to set up a new bare trust with its own corporate trustee, right?
That's right.
Okay. So these things are very important for people to understand, to make sure they're compliant, because the self-managed super fund gets audited every year.
That's right.
And if you're non-compliant, it's highly regulated.
That's right. The tax rate is no longer 15%; it goes up to 47%.
Exactly. And then you're doing that move, which will work in your favour in the future when you're retired. And then if you're doing the wrong thing, it can backfire, and you end up in a worse off position.
Correct. Yeah.
So that's why it's very important always seeking professional advice and people who know what they're doing before making these steps, because you're just pretty much gambling in your future and your money if you're not doing the right thing. So what are the key compliance requirements in a self-managed super fund? So we talked about the limited recourse borrowing arrangement and the bare trust setup and the corporate trustee. What are other compliance arrangements?
So every year you need to prepare a tax return and financial statements. And in addition to that, it has to be audited by an independent auditor. So we can manage that process for our clients, and we pass that on to an external auditor that goes through the work that we have done to prepare the tax return and financial statements so that it's compliant.
What would be a rough cost to do that every year?
Yeah, in terms of the annual fees, it's around $2,000 to $3,000 per year.
That's preparing the tax returns, financials, and the audit. Okay, so that's something also you need to be mindful about. That's besides the initial setup costs that you have to allow for.
That's right.
So probably initial setup would be similar, $3,000 to $5,000 as well.
That's right. Yep.
And depends how many bare trusts and corporate trustees you need to set up. So
Correct. About 2.5 for the self-managed super fund, 2.5 for the bare trust.
Yes. Okay. So everyone's doing properties and self-managed super funds. What are alternative strategies to invest in your self-managed super fund? Because it's basically yours. You can do almost whatever you want in terms of investing or where you want to put that money. Like I had a client who put 100Ks into crypto using his self-managed super fund. Now he's lost $30,000, but hopefully it will recover. But what are other strategies that you can do in your self-managed super fund?
Yeah, look, in terms of that, what I was thinking was, with buying property, obviously you can buy it outright within the self-managed super fund. If you have the money available, you can buy it with the LRBA in place so that you're borrowing. Well, the other option is there's another couple of options, would be to purchase property either through a geared unit trust or a non-geared unit trust.
Can you explain that point?
So what that is there is that you may not have all of the funds available in your self-managed super fund, or you don't want to borrow, or you may want to purchase a property with other parties.
Yeah, okay.
So you set up a unit trust outside the super fund, and the units in that unit trust are then purchased by your super fund. It could be purchased, some of the units could be purchased by your investment trust.
Okay.
We could purchase something together.
How many parties can you have?
As many as you like.
Unlimited.
So, that's right. So it's really just another way of pooling resources to purchase a property.
Yeah. Obviously, we're not talking about the risks of having multiple parties involved, but it's legal. Like it can be done. All right. Any other alternative strategies? Like this is not many people know that, and obviously you need someone to advise you on that and how to set it up correctly.
That's right, and there's quite a few different rules and regulations around the geared and non-geared unit trust strategy.
Yeah.
So it's something where you need to get obviously advice around that so that it is compliant.
Perfect. I think to end our podcast today, what is the key difference between an accountant who is doing what needs to be done as an accountant and your general tax agent accountant? What value an accountant should and can bring?
Yeah, look, I think with your accountant, you've got to look at them differently from the point of view of don't use them as someone to do the end of year work, because that's something that anyone can do. You want to get the most value out of them by seeking their assistance and guidance throughout the year. And also when you're involved in any new transactions, you want to get that advice up front so that you structure things correctly, because that structuring is key to making sure that you get the maximum benefits from your investment strategy.
Absolutely. Absolutely. That's key. And if your accountant is just a tax agent who's doing your taxes at the end of the year, and you're self-employed, you're trying to build something, you're trying to create wealth, you're trying to plan for the future, you definitely either need to have a chat with your accountant and see what value they can bring to the table, or find yourself an accountant who will be along your side on that journey and give you the right advice, which can save you heaps of dollars down the line. So please be mindful about that part. Richard, any last words? Or we've covered, look, the accounting is huge, so I wanted to stick to property side of things. So anything else you would like to add before we finish? Or
I think that covers it. I suppose the main takeaway from this is to seek advice. Spending a little bit of money at the start is a drop in the ocean, to what you can achieve at the end of the day. So don't be scared to ask questions, because everyone's situation is different and the best course of action is unique to your scenario.
That's it. Thank you very much for your time. I really appreciate it. And hopefully we can do another one in a few months just to cover other topics. That's it for today. Thank you for watching or listening. Please leave us a review or send through any questions you might have. And please don't forget to subscribe, and we'll see you next time. Thank you very much.
Bye.